Hey everybody, Colin Plume, CEO Noble Gold Investments. Fun, exciting day we have planned. Got my friend Micah, one of our top sales representatives over at Noble Gold, is going to come in and break down some charts and graphs. So Micah's going to be with here for the whole simulcast here, which is exciting. And yeah, we'll dive right in. Let's talk about NVIDIA. Let's talk about the stock market. Hey, Micah, how are you? You're in. They finally let you in there.
Really well. Thanks, Colin. Yeah, thanks for having me on.
Yeah,
Really exciting
absolutely.
time in markets.
Yeah.
Absolutely.
Exciting to have you on. Lots going on in the news. Let's dive right in with NVIDIA, DeepSeek. Well, let me ask you: have you tried DeepSeek yet? Are you afraid to? What are your thoughts on DeepSeek?
So I jumped in first thing Friday as soon as this thing had broke, which was really kind of after market close Friday afternoon, and I spent the weekend following all the news on this. So since then, and kind of to your point, which you alluded to there, there may be some security concerns about IP addresses and stuff like that, which of course we only found out afterward.
Right.
But I'm impressed. I'm super impressed.
Me too.
I've been using OpenAI for a couple of years, better part of a couple of years. And I think what we're seeing here is the, again, kind of ability of trying to do a lot on a little bit of a shoestring budget and to be able to punch above its weight in terms of what this thing can do, but what this thing actually costs. So of course it's, Chinese ingenuity at it again in another sector.
Absolutely. Yeah. And I think, I used both. I did some ChatGPT, DeepSeek. I looked at, and I was impressed with the input that I got back on some of I just tested it out in terms of some marketing cues. And I thought it was really in depth. And so people are like, what is it? What happened? Right. What really happened? What really happened is that DeepSeek said, we can do what ChatGPT is doing at a fraction of the price. They used computers that people thought were too slow, too old, and built this product that is very similar to ChatGPT. The cost is, I think you can sign up either for free or a few dollars a month, where ChatGPT is charging anywhere from $50 to $200 a month.
Yeah.
It's a massive, it's not from $2 to $4, right? I think to go from $2 or free to $50 or $200 a month. I mean, this is a shattering competition.
Absolutely. And so, ChatGPT and OpenAI, as you know, has been really hammering the hardware side of the AI race, where they've been acquiring all these chips from NVIDIA. And, the amount of investment that's happened in the AI space and in NVIDIA over the last 2 years is amazing. It's really, it's hundreds of billions of dollars. And so as opposed to going kind of the horsepower route, where they're actually having all of the physical hardware to compete, they've found a way to have software that can compute and essentially, without all the expensive hardware, DeepSeek is able to punch above its weight simply from a computational kind of software perspective. So, it calls into question, have these hundreds of billions of dollars that have gone into OpenAI and NVIDIA, is it really worth the cost, right? Were the big ticket price tags on these companies actually worth it after all? And I think that's what we're finding out now. And of course, turbulent day yesterday in the market.
Yeah, absolutely. And also, it's been something I've been talking about for a long time, is that the stock market growth is too narrow, that it's in 7 big companies.
Absolutely.
And that risk is not deferred, or not deferred, but it's not, it's locked into so few companies. 25% of the S&P growth over the last few years has been tied to NVIDIA and these major companies.
Absolutely.
And so, if you see a competitor that can come in on pennies on the dollar and offer a similar product, I think it's going to send shockwaves, and it did. It seems like NVIDIA bounced a little bit up today, maybe a dead cat bounce, but I think that overall, people are going to be looking at this stock, and they're going to look at other competitors coming to the table, because this is just the beginning, right?
Absolutely. And on that point, Colin, I think it's not necessarily that DeepSeek is the solution to AI, or that it's actually itself the only disruptor, but I think what it shows is that the kind of stranglehold that we thought USAI companies were going to have
Right.
exclusively on this space. And, the price to earnings that has really been kind of projected through the stocks that we thought were going to monopolize this space for the next 20 years, that's all now kind of up in the air. So it could be another company next week. It could be another few companies within 6 months. But we know that the disruptive technology is out there in this space, and there's going to be a lot of competition, and there is no more monopoly.
Yeah, absolutely.
Basically.
Yeah, it actually, funny enough, it reminds me a little bit when I started in the gold business. We were nobody, we were nobody, and everybody was doing it a certain way, and we came in and did it a completely different way, where we built it on relationships and really smart, people that had clients, and they built long-term relationships. The gold business was very transactional when we got in the business, and now we help people with their IRAs, and we're involved for a long time, and they call us back, and it's become more of a long-term relationship.
Absolutely.
And when we started, people said that that's not what people are looking for. And I actually think we prove that, people do want that, connective relationship with somebody in the metals business.
Yeah.
So yeah, it really changed it. So there's going to be disruptors, as you mentioned, and it's exciting, and we'll see what happens over the next few days. I mean, there's obviously the Fed meeting, a lot happening, but I'll hand it over to you. I did want to get NVIDIA first, but I'll hand it over to you. I know you got a lot of charts, exciting things to talk about.
It's great. Yeah, let's dive in. And we did, cover a little bit here. So let's sort of jump over to the next slide. Just going to review kind of stuff that I intended to cover today. So obviously we'll talk about tech stocks. We'll get into what I'm referring or kind of identifying as a capital rotation event, which I think is on the horizon. We'll talk about stock market volatility. You just mentioned we've got a FOMC meeting today and tomorrow with a rate decision scheduled for tomorrow. How that impacts bond yields and obviously debt markets in general. And then we'll get into some kind of more pertinent stuff with respect to our market, where gold and silver have come the last year or so, where they're going, I think, in the short and medium long term, and then some gold to silver ratio stuff. And then we'll kind of do a separate thing on tariffs and obviously how that's impacting the industry or how we think it might. So, to our point, lots of disruption in this space. AI and the Mag 7 have really carried the stock market, the US stock market, these last couple of years. We know that they are responsible for a disproportionate amount of market cap within the S&P 500. And we think that makes general markets extremely vulnerable to whatever happens to the Mag 7, to the stock market leaders of the last couple of years. So, when you've got market breadth and all companies are kind of sharing in this massive market trend, we actually have the opposite, a very narrow market where it's just these few that are kind of carrying everybody up. But we know that they could do that both to the upside and the downside. So what we could see here is some kind of domino effect that could lead to a larger market sell-off, and then we'll get, again, what I'm calling the capital rotation event, which would be a flight to safety and into the safe haven assets like gold and silver. And so if we kind of go to the next slide here, what I've got here, we may just need to move our screens over if we can. If not, that's okay. But what this slide shows, thank you very much, is that blue line is the market cap of the Mag 7. So the Magnificent 7, that's Apple, Amazon, Meta or Facebook, Microsoft, NVIDIA, and Tesla. These guys account for nearly 60% of the market cap. That's the S&P growth, pardon me. So the blue line is S&P growth. So they have contributed to 60% of the S&P 500's growth over the last several years. And so that red line below is their market cap. Those 7 stocks account for just a little over 30% of the entire index.
Has that ever happened before, Micah?
So to this scale, where again, there's so few stocks that are carrying the rest of the market, no. Of course, in the 60s, you had the Nifty 50. I'm sure you've heard of that, and a lot of our clients have. where you just bought the Nifty 50 and you'd do fine. Well, same thing. You buy the Mag 7 these last couple of years and you'll do great. But it is somewhat reminiscent of even the kind of 95 to 2000 .com bubble, where you just had this mania in a new sector. The internet was going to change the world. And of course it did. But it didn't right away in the year 2000, right? And just like with AI, very disruptive, will change the landscape of our world, increase productivity and all these things. But right now, is that going to be where we see all the kind of benefits manifest? I think it's probably going to look a lot like a .com bubble once we're on the other side of it. And of course, hindsight will be retrospective, but these things could keep going for another while. I think maybe weeks, months, maybe quarters at most. But the purpose of this chart was just to show you how disproportionate the market growth and market cap are in the S&P 500 amongst these just 7 stocks.
I will say something that's interesting too, is that I think as someone that gets investment opportunities presented to them all the time, that over the last 5 to 7 years, it was blockchain opportunities, venture capital, blockchain. It shifted when a lot of those opportunities proved to not be, successful, shifted immediately to AI opportunities, meaning all these AI opportunities to invest venture capital money. And the thing that you realize is that a lot of times, a lot of it is just raising money. They're just raising money in a sector, and smart money is like, they see a catchword, they jump on, and now AI. And there will be massive amounts of losers in AI. And
right.
That people need to keep that in mind, is that not all investment in a category will win. And there will be so many losers that are happening. And so that's what DeepSeek sort of proved, right?
Exactly.
Is that you don't always need to spend as much. And so people need to be careful when they look at these things, as they see these, oh, well, I want to be an AI. I want to be, it's a, $15 trillion potential industry. I want to be there. But a lot of it is the raising of money, selling of money, all this venture capital. When the Nifty 50 ran, there was no venture capital, right? I mean, these ideas, these firms that come out are just raising money for areas because they make money on the raise. They don't have to prove the product.
Exactly.
And that's a new world. So anyways, I did want to mention that for me as an investor, an accredited investor, I get these calls, blockchain, now it's AI, and then there'll be another thing in about a year that they'll try to sell me.
Exactly. So we can move on from this. I want to drill down a little bit, obviously, into DeepSeek and the competitive advantage that they've shown. It's had a direct effect on NVIDIA. So this was NVIDIA at yesterday's close. Of course, you mentioned earlier, Colin, that it did, it's popped today. It's up 5% or so. So maybe that's a dead cat bounce. I think it was quite oversold, but we do still need to see these things resolve. You don't go straight up. You don't go straight down. You're going to have kind of little bounces along the way. But a fairly significant drawdown yesterday. And I'd like to go to the next slide, which again kind of drills down specifically into NVIDIA. It just shows you that this is a trend line that's been respected for over 10 years at this point. And NVIDIA has, within this upward channel, it shows us that we're in an upward trend. It has, again, along the way, hit the top line, which is the resistance, and then it's come down to test that bottom line, which is support. So we've got multi-year resistance, multi-year support, and we've been more or less respecting the parameters of this channel. But in 2024, we had a breakout of resistance. And when you break resistance, of course, you tend to put in a fairly significant move to the upside. But we see it now coming back into that channel, and we're at this really interesting place where we could actually see the beginning of a move toward the major support line, the bottom portion of this channel. And just as a little too small for us to see right here, but a revisit of the bottom part of that trend line effectively is a 75% drawdown.
75%?
It's a 75% drawdown in the price of NVIDIA. Now that is kind of, again, reminiscent of Cisco losing 90% of its stock value, Amazon losing 90% of its stock value in the post-2000 dot-com bubble. So again, no crystal ball here, and this may materialize to correction and a retest of that support line, the bottom of that trend line, over the next couple months, maybe the next year or two. We won't know when, but we do know that we're in a massive bubble. U.S. tech stocks are, some of the most richly valued stocks we've ever seen in any cycle. And again, hindsight will be 2020, but this kind of has trouble written all over it. So if we're simply going to retest the bottom of that upward trend line, it's a 75% correction in one stock, but as you pointed out, disproportionate amount of weighting in a U.S. stock market indice means that the NASDAQ and the S&P would be in for a major correction if we are going to see a retest of that bottom trend line. So I think it's just interesting to keep in mind how vulnerable the whole space is based on the performance of just a few stocks.
Yeah. Sounds, and this kind of leads me to my next thing. It sounds like something my buddy Charlie Kirk has recently said. Let's cut to Charlie.
With the stock market at record highs, are you confident your portfolio can weather the next big downturn? Market corrections are quick and unforgiving, wiping out hard-earned gains in an instant. Smart investors know the key to financial security is diversification. That's why Noble Gold Investments makes it easy for Americans to help hedge market volatility and diversify their investments with gold. Since 2010, central banks have steadily increased their gold reserves, and in 2024, gold prices soared over 25%. Gold is simple. You buy it, you own it, you control it. Over $2 billion in precious metal sales, Noble Gold Investments has helped thousands of investors diversify their portfolios with gold IRAs and physical gold. And now, when you open a qualified account, Noble Gold will gift you 5-ounce silver America the Beautiful coins as a thank you. Don't wait for the next downturn to catch you off guard. Visit noblegoldinvestments.com today and see how easy it is to incorporate gold into your investment strategy. That is noblegoldinvestments.com, noblegoldinvestments.com.
Back to you, Micah.
That's a great message. It's very timely, and it's something that I've been very emphatic about, which is stock market valuations at record highs is the best time for our clients to crystallize that wealth, to crystallize the value of their retirement accounts in physical metal. Don't wait for the 20% drawdown. Don't wait for the NASDAQ to blow up. At that point, you're buying gold at a much higher price, and you're doing it with less money in your portfolio. So we're not saying roll it all into gold, but we're saying this is a perfect time where the stock market could continue higher for some time, but you're risking a lot kind of at the 11th hour. So it's a great time to be crystallizing or locking in the value of your retirement account with gold.
Absolutely. Yeah. Question for you, Micah, from the audience, from Marita. Will tariffs on copper drive the price up? She wants to know.
I think it will. Of course, copper is an industrial metal, not one that we deal in here at Noble Gold Investments. We're focused on precious metals, but there's a lot of unknowns with respect to tariffs. We will see dramatic increases if it's across the board, right? If we see industrial metals whacked with a 25% or more tariff, it'll certainly have an impact on the price. Now, mind you, copper's, they call it Dr. Copper, can be a bit of a recession indicator. So, if we do end up in a recession, the price of copper could drop. But the price of copper going up, which it seems to have been the last little while, is also indicative of inflation. So it's an interesting commodity to monitor. And I think that we'll find out more in the coming days. We're not too far off from when some tariffs are supposed to be coming into effect here. So we'll certainly find out more. Thanks for the question.
Great. Great. Yeah, that was the one question that she had about copper.
Great.
All right.
We can, sorry, Colin, we can move on just to my next slide, which sort of goes to my point and Charlie saying what a great time it is to actually take some of those major gains that our 401k and IRA clients have seen over the last few years, crystallize and lock those gains in with physical metals before a capital rotation event. And I do think we have a capital rotation event on the horizon. Just to kind of put it into context and perspective, a capital rotation event would be like a dot-com bust of 2000. It would be like a global financial crisis of 2008, where the aftermath essentially has precious metals in a multi-year bull market, and where you can actually see multi-year bear markets in stocks. And so when capital decides to exit these overvalued sectors, whether that's kind of reactively in a crash or proactively, which would be preferable, they're trying to find safety and they're trying to find value. So they're going to be leaving these overvalued sectors to find what's cheap. And frankly, gold and silver are extremely cheap, provided with the risk that we actually have out there in the world and in the market. So capital rotation event is a huge, it sends us into a huge multi-year bull market for precious metals, and could also mean a multi-year bear market for stocks, and just sort of kicks off general volatility for the stock market as well.
Yeah, and I always, one thing to talk about too is that people, wealth isn't gone. It's just moved, right? It just moves to a different place.
Right.
And smart investors see those opportunities. And it looks like wealth is gone. And for people that are stuck there or have to sell in those down markets, the wealth is gone. But for people that see opportunities, there's actually a lot of wealth created in these capital movements. And you're talking about 2000 and 2008. I mean, these are pretty big time. 2022, there was some capital movement that happened there.
Exactly.
Bear markets. So
yeah.
And obviously we know the number one thing is bear markets are much faster than bull markets.
Exactly.
They happen much quicker.
Especially if we have that added element of increased volatility, which I've got a couple slides on coming up here. So
let's get into that.
So if we kind of move into the next one here, stock market volatility, just to frame it for our clients, those that aren't familiar with that term, volatility is really the degree or variation of change in the price of financial assets or markets. And in other words, it just means like how quickly can the price go up or go down. So higher volatility means that we've got sharper, more unpredictable price swings, whereas low volatility means that we're in more stable, kind of gradual changes. And that's certainly been, we're coming out of a relatively low volatility period. And I think we're coming into, and there are many people talking about this, saying that 2025 and onward will actually be a period of extraordinarily high volatility. And I've got an interesting chart on the next slide that shows you kind of where we're at, uses a little bit of technical analysis. This is really simple stuff, but it looks complicated. So I'll just walk you through what this is. One of the measurements of volatility is an ETF called UVXY or UVXY. And the long and short of it is it kind of shows us a put-call ratio. But the higher these prices spike, and it's not really a price, it's again just a measurement of volatility, that's when you're getting a dramatic change in the stock market. And so down below in white in that quadrant, I've shown you something that's called a downward wedge. And this is a technical analysis formation that typically resolves to the upside once you make your way toward the apex or the kind of tip of the triangle. And you can see a clear kind of downward wedge, falling wedge pattern here in UVXY. Now this is from August to now. If you look on the sort of far left side where you've got that little volcanic eruption toward the taller part of the triangle, that was the volatility that we saw in August. So in August, Colin, you'll remember on the 31st of July, we had a Fed decision or a Fed rate decision, Fed funds rate decision to hold. And that actually shocked the stock market. They were expecting cuts. They were expecting easier money. And the fact that they didn't get that at a time that it was expected sent it down about 5% in just a couple of days. It was actually less than a week. But so a small 5% change in a short period of time in the stock market can actually spike volatility. And the formation that we're making now, this falling wedge pattern, is eerily similar to what we had in early 2020. Now, 5 years ago, at around this time, Colin, you'll remember it was COVID. COVID shocked the world in January, February, and it shocked the markets in February and March. And what I think we're seeing now could be something very similar to what we saw back in 2020. And if we go to the next slide, we'll see how that turned out. So when we got into the apex of the falling pennant formation in 2020, we didn't know what the catalyst would necessarily be, but COVID is what actually allowed the markets to erupt. What we had then was obviously global lockdowns. It was a global pandemic that crashed the stock market by about 20% in little less than 3 weeks. We saw extreme volatility during this time. The metals were hit very briefly, very temporarily, because when we have these major liquidations, gold and silver are viewed as tier one liquid assets, and they're often sold to get the cash to kind of save yourself, save your shirt, save your portfolio from margin calls and these other things that were happening. But what happened after this volatility spiked was the summer of 2020 rally in the metals, where gold went from 1,500 to 2,000, and silver went from $11 to 30 in a matter of months.
6 months. Yeah, it was. And by the way, that pullback happened in end of 2008 in the gold and silver market too. The same exact thing. It was a liquidity crunch. They got cash, and then the Fed came in and announced quantitative easing, which is what I think they're going to do again. And they flooded the market with cash. And from 2008 to 2011, gold and silver went on a massive run because they were just printing money, and they opened up the money supply, which I think they're going to do again, because they've been very tight for the last few years because they're worried about inflation. And the dollar has gotten very strong. And, that bodes well for certain things, but it also makes it very difficult for us because we are borrowing some of that money. Also, it makes things quite expensive. We're trying to sell goods overseas. Now they're more expensive because our dollar is so strong. And I think that if the Fed can't lower rates, then I think they're gonna look to do a QE push.
And we're going to talk about that coming up here really shortly. But I agree with you, Colin. I think, when things look similar, it doesn't mean they're going to go the same way. But the reaction that we had in 2008, in 2020, where markets pull back, so do the metals very briefly. But then what I've sort of, am defining as capital rotation event, in that fear, in that volatility, all of that money that's either in the markets or in cash will then fly into the safe haven assets like gold and silver. And that's when they go on a multi-year run. So if, we want to talk about a couple of things outside of NVIDIA and the kind of tech stock market vulnerability, there are a few other things I think that could, provide us with catalysts for a market crash here in the coming days, weeks, months, who knows? But let's move on to the next slide here. So this is, I think, something that's worth a conversation. Of course, we've seen the news. Trump's off to an amazing start his first week after being inaugurated last Monday. He's out of the gate, guns blazing, doing a lot of the things that he said he would. But we know from the Fed speaking at the end of December, when they cut by 25 basis points, they had actually taken off a number of the expected rate cuts that were on the dot plot from 2024. So there were going to be, I think, up to 8 rate cuts in 2025, and they cut that down to only 4. The tone that Powell had at the end of December more or less was, we remain dependent on data. They're looking really at 2 things, inflation and unemployment. Right now, both of those things are, unemployment relatively low, inflation, of course, lower than where it was a couple of years ago, but they both are kind of looking precarious and beginning to tick up, which of course means if unemployment's ticking up, it's in a recessionary sign. If inflation's ticking up, obviously that means that they don't have a handle on inflation. And so they're really kind of in this tough spot where they want to remain independent, relied upon data. I actually think they're between a kind of a rock and a hard place. But Trump has come out, it was sometime last week, saying he wants lower rates. He expects lower rates. And I think, to paraphrase, he more or less said, yes, he's expecting that Powell's just going to listen to him and kind of give him what he wants. Now, of course, we want lower rates to spur the economy, get job growth going. And I think we're going to see a lot of that just from some of Trump's policies anyway. But if we cut rates to kind of boost the economy, we're also going to lose control of inflation. And so Powell's very hesitant to do that. But Powell also stated just in the fall that he knows that we have had a very tight monetary policy and we have had rates too high for too long. And so he also doesn't want to hold for too long because we could see unemployment beginning to tick back up again. So there's this challenge where he is not going to want to, what's the word I'm looking for, more or less kind of bow to Trump right out of the gates. He's going to want to kind of maintain his credibility and his independence, but he's also not going to want to get into a big fight with Trump right out of the gate where, Trump could call for his resignation or something like that. But again, I'll note from last week, Powell was asked directly by a Washington Post journalist, would you leave if asked by Trump? And he flat out said, absolutely not.
Right.
And there's no legal basis for that. So I think markets probably need lower rates to continue this upward trend. Without them, we'll likely see some form of correction. But again, with rate cuts, might be good for the stock market for the short to medium term, but then we've got inflation ticking back up and hurting consumers. So
100%.
it's a really sticky spot to be in, and I don't envy Powell at all.
Yeah, no, and I think that's what I've been saying a lot when people are talking to me. It's Trump's strategy is high growth, high inflation. There's no middle ground to what he's trying to accomplish.
Right.
And this is very much what a business person would do. They would spend money to make money, right? That they're not going to sit around and wait for things to happen. They're going to be aggressive and try to grow, the economy, grow the GDP. These are the things that they want to do. But yeah, I mean, all roads lead to inflation, I think, as Paul Tudor Jones said in November of last year. And so that there's just kind of no way around it. Even if they don't lower rates, I still think inflation is going to be sticky for this whole year, even if they do nothing.
I agree.
I have a hard time believing that they're going to be able to do absolutely nothing. So it is a very difficult position.
It is
to be in right now.
So this next slide just shows you quickly what the market's pricing in for tomorrow's cut. So typically the market's generally correct. So we've got a 97.9% probability of Powell simply marking or holding rates at the current funds rate. But the tone, again, and probably now more than at any time in history, does the tone from the Fed chair actually dictate, the sort of immediate direction of markets. So if he were to come out and be extremely hawkish, which means tough on keeping rates where they're at, saying that we want to really ward off any return in inflation. If he says kind of along the lines of we're keeping rates where they're at until further notice, and we're worried about inflation still, so we're not committing to any cuts, in the shorter term. We're just going to see how it goes. I think that'll be all you need to spook an already spooked market.
Yeah, 100%.
And we could see a continuation of this kind of waterfall effect in tech stocks and then in the major indices as well. Yeah. But then, of course, Trump's response to that will be very, very interesting to note, and we'll see how things play out from there. So this is a great place to go next. So on bond yields and the 10-year U.S. Treasury note. So we know from the middle of September when they began to cut, that's when they did the big 50 basis point rate cut. We all thought that mortgages would come down, any form of debt would come down. But what happens is when the Fed adjusts the Fed funds rate, they really only impact kind of shorter term debt. The 10-year, we know, essentially controls the majority of debt markets. And what we know from what happened in 2020 and in 2021, Colin, is when you lower rates dramatically, it leads to inflation. So we have this kind of not recency bias, but markets, especially the bond markets, basically not forgotten the lesson of the last few years, which is if we're lowering rates, we're going to bring back inflation. And so if we look at the chart on the next slide, this just shows us the yield on the 10-year. And when you see that kind of middle of it there, where it was fairly low come middle of September, the 10-year yield had actually been dropping pretty much all year. But that 50 basis point that's marked by the letter C there, that actually kind of marked the jump in yields and the pricing in of inflation down the road. And so the bond market, and what's been referred to, this is a term kind of in the 80s, bond market vigilantes. It's like the bond market is controlled by investors and capital flows. So if people are selling bonds, they don't want to hold them, you're going to have yields spike. And if people are buying bonds and the price of bonds is going up, you're going to have yields come down. Well, people don't want to own bonds long term if we're cutting rates again because it's inflationary. And so the few bondholders that we have now that are left demand a higher yield. And what I think could happen, at least in the shorter term, is it has corrected just for the beginning of the year in 2025. But I think we're probably ready to take out that high from the end of December, and we could get back into the 5% range. We could see something like that.
And wouldn't you say that the bond market, in essence, is saying the return's not enough, right? I mean, that's really what they're saying. They're saying that we need to make more on this to lock in our money. We need to make substantially higher than this 4.6, 4.7%.
Yeah.
And the last time that happened that we had rates even this high was 2008, right? I mean, 2008 was the last time we saw rates on the 10-year near these numbers. So they're saying inflation's going to be higher. I'm going to be able to get bonds at a higher rate, which means that, the market's got a lot of room, that the bond market's going to continue, and there's going to be more selling. They're going to continue to be selling bonds because they anticipate they're going to be able to buy these 10 years in the 5 and the 5 1/4, and who knows, where things go.
That's right. And in the meantime, we've got debt markets across the board that are pretty much dying for lower rates, but aren't getting them despite these cuts from the Fed. So I saw an interesting stat yesterday, said 71% of realtors in the United States had no closed deals in 2024. We know this is impacting the real estate market. Prices haven't necessarily started to come down, but of course you're seeing it kind of on the front end with lack of sales and historic low sales volume. On the other hand, you've got a ton of corporate debt that was taken out in 2020 and 2021 at these really, really low rates that are now kind of coming into a big renewal wall in 2025 and in 2026, because some of these corporate debt instruments are 5-year kind of rollover. So a lot of corporate debt's going to be rolled over at rates that are 3-4 times higher than they were when they took on all this debt during COVID.
I've been talking a lot about the debt, the commercial debt, and really the strategy with banks right now is extend and pretend. That's really the strategy that works. That basically they have loans coming due this year. Commercial mortgages are anywhere from 3, 5, or 10-year terms. People may not be aware. So office buildings, apartments, retail, they don't get 30-year mortgages like homeowners do. So they're coming due. Billions of dollars are coming due, and these properties rents are down or flat. Vacancy is up, and the bank has to underwrite the deal to what it is today, plus adding in what the rates are. And so a lot of these, and I can tell you, I know so I own, apartment buildings. I have debt at 3.25%, 3.75%, 4%. If you rewrite that debt today, it's going to be in the high 5s, low 6s. So the bank, instead of rewriting the debt, it maybe extends at some middle ground for a year and then they're going to see what happens in a year. Otherwise, the other option is that they'll end up rewriting at this much higher rate, and then the borrower can't afford that higher payment.
Right.
And then they'll foreclose on the property, which is the worst thing that could happen. We all know what happened in 2008, 2009, is that the government had to come in and bail out the banks. And so the goal today is to avoid that situation, because in essence, the taxpayer ends up just paying for it, right? When we bail out the banks, it's just another form of inflation to the taxpayer.
Yeah.
And so that's what they're trying to avoid. And that's why this whole thing about rates is so important.
Very.
You have so many jobs. You have 71% of realtors that made no money last year.
Yep.
You have all that tax income that's not coming in that we need as a government right now. We have all that income for that individual that didn't make any money.
Yep.
So there's just so many layers to this, that the commercial debt bubble, I mean, it's just
Agreed.
a massive bubble. And then, Trump has mentioned that they want to sell a lot of their office space. So now you're adding more office space to the market.
Exactly. More inventory,
which is going to drive the price down
even further.
And it'll create a lot of great opportunities for, people that have wealth, that have assets available. But it's also putting people through a lot of pain. And that's why, you and I always talk about diversification.
Yeah.
Because if you have all your eggs in the real estate basket right now, you're in a lot of pain. It's tough.
Another interesting and related point is, we know that there were a few banks that went bust in the spring of 2023, Colin, and that was madness here for us, right? That was out of the blue panic buying, everyone wanting their money out of the bank because they didn't know which one comes next. I think the banks are more vulnerable than people want to believe. And it's because a lot of hold to maturity assets like bonds or, commercial real estate mortgages, they don't actually have to really disclose the losses that are being incurred because they're longer dated assets. They don't have to have that kind of that live portfolio loss calculation. But it could just happen all of a sudden again at some point that another bank goes down. Maybe it's not smaller regional banks this time. And so, gold and silver physically get you out of the dollar, get you out of the bank, and they're out of the market in a sense that you're in a negatively correlated asset most of the time. When the stock market goes down, the metals go ballistic. So getting some of your money out of the bank and into a format that can't be taken from you, has no counterparty risk. It's yours. It's physical. It's there. And again, you have no currency exposure. The banking fragility or banking system fragility, I think, is kind of an understated risk.
Yeah, there's going to be a lot of banks that go out of business this year. There's no doubt about it. In 2023, that was a bond, collapse with a lot of those banks because they bought bonds at the wrong time. Now it's going to be a debt bubble. They're going to they're just going to run out of ways to cover. And they're going to have a lot of loans come back, and they're going to have a lot of people stop paying. And, it's a very difficult situation for those banks that, not that I feel bad for banking system, but you do have to have banks available. People need to move money around.
Properly functioning. Absolutely.
Yeah. And so it is quite desperate times. I think people, I say it a lot. They look at these rates the banks are offering, these 4.25%, and just because they're offering 200 or 300 basis points more than they were offering a few years ago, it's just because inflation is so much higher that they're able to offer these 4% returns in the bank, and they feel like they're better. People get excited about it, but then when you look at the cost of goods going up 15-20%, or the cost of energy going up, the cost of everything going up, food costs going up 15-20-30%, the 4% sort of feels like you're getting stiffed a little bit.
It's a negative real return, right? So you just can't protect your money enough, and even in a long-term bond with yields of 5%, it's just not enough to actually hedge from inflation, right? So I think the bond market, to come back to it and maybe kind of just summarize, is we will probably see yields continue to kind of rise higher. Now it might not be a big steep move, but I do think that until a time when the stock market crashes and there's a lot of buying for bonds. And if there's a lot of buying for bonds, the yields should come down. So in a stock market crash, I think 10-year yields could come down, but until that time, I think they go up. Next is going to be, Colin, let's move to gold. Actually, this is sort of, I'm going to look at a few gold charts here. So I've been calling 2024 was the year of gold. This chart kind of shows you what I mean by that. So, we mentioned the COVID crash in 2020. The markets in February, March crashed by 20%, and then gold and silver took off. That year, gold went from 1,500 and change, and it made a high at $2,090, and that pretty much put a ceiling on the price of gold for the next 4 years. So you see that we saw gold kind of go sideways for that 4-year period. It made a low of $1,600, and that was sort of in the fall of 2022. But 2024 was the year of gold because we finally broke above that all-time high, that resistance, that ceiling on its head. And as soon as it did, it flew to 2450. That was really around March of 2024 to May. It made a new high around 2450. It spent the summer going sideways, and then it made an even higher high just in October, right before the presidential election at $2,800. And so 2024 was the year of gold because it broke the suppression. It made new all-time highs, and we are going to see even newer, higher all-time highs this year. But this is what I'm kind of showing as a longer-term chart, and the bull market that we're in. I do have to say with some honesty that in the shorter term, there are a few things piling up that actually would give our listeners and our clients a great opportunity to get in. If we're right about the catalyst this week of NVIDIA crashing, tech market instability, maybe something around a hawkish Fed, we got to remember this week is also Chinese New Year. And there's not a lot of buying of gold and silver. I think that in the shorter term, if we go to the next chart, there are a few indicators that make me think that the price could come down. So what we're seeing here on the top half with that rising red line is the recouping of our all-time high. It actually made a slightly marginally higher all-time high, just above $2,800, and that was just last week. But down below, you've got something called the RSI, which is the Relative Strength Index, and that's more or less a measurement of momentum. And so you've got a slowing down of momentum and a rising of the price, and that's called negative divergence. And 80% of the time, now it's not a perfect method, but 80% of the time, what that implies is that we're going to see the price almost like a baseball. When you throw it straight in the air, it's still going up, but then it kind of sputters, runs out of speed, and we're going to have it come down a little bit. Now, this could be a simple retest of the, call it 2,500 range that we have here post-election. That's more or less something in the ballpark of what I see. And that could coincide, Colin, with this kind of across-the-board liquidation. This is why it's an interesting indicator, is it happens to be turning down at a time when the other general markets are also looking very fragile. So if I were to hypothesize what could happen over the next month or two, would be turbulence in the stock market, a slight pullback in gold, and then that capital rotation event is in play. And you've got now gold that'll go and shoot to my annual target, which I think is going to be somewhere in the $3,200 an ounce range. But first, in the shorter term, I actually think that there's a great buying opportunity coming up, which could coincide with other markets also selling off.
So based on your analysis, if it hits this, then we'd have basically like a $700 swing in the price from if it hits 2,500 to about 3,200.
Exactly. Yeah. And it looks even better for silver, which we can take a look at next if you'd like. So our next slide here, this is more or less my expectation for 2025 in silver, my kind of macro view. And I've called 2024 the year of gold. I think 2025 is the year of silver. Now, what that what that I think that means is we make a new all-time high, and we basically challenge that $50 mark, which of course held not only in 1980 but in 2011 after the global financial crisis. So in the fall, we got up to just shy of $35, and again with the election, the dollar surging, like with gold, it pulled back, but it's got very positive signs of hanging on to that $30 mark. Now, if we can close above 36, we are going to go to 50 in a relatively short period of time. Okay. Now we may hit that 50, which again is long-standing 40-year resistance, but I only think we would pull back from that briefly before we move into an all-time high. I think we could see silver in the 60s within the next year. Okay. But in the medium term, I think 2025 is a year where we kind of break that suppression, re-challenge a new all-time high, and like gold, shoot above that. But on the next slide, I'd like to just point out we are seeing similar technicals. The formation that we have silver in right now, that's on a rising channel, is referred to as a bear flag. And so if we do break below that support line, the bottom of that channel, we could see a retest of where we were just in mid-November at around $28. So if we look at the lines below, I know it's harder to see here, but you've got that relative strength index, but also the moving average convergence divergence, or MACD. And what those are, again, are just momentum indicators. So while we have the price actually rising, you've got momentum indicators which seem to be turning down. So again, that kind of ball you throw in the air, it's rising, it's slowing down, it's going to come back down. In the very short term, that could coincide with a larger stock market liquidation, and then that would be our gift. You get in $28, give or take, in silver, like that $2,500 in gold. But minimum target for silver this next year will be in the $45 an ounce range. And so that's $20 or $19 gain. It's a 70% move maybe in the next 6 months. So again, shorter term risk is to the downside. It's a great opportunity, maybe one of the last key buying opportunities before we get a challenge of that all-time high and we mark the year of silver in 2025.
Yeah, a lot of these charts, not this chart, but the chart before, is very similar to some of the charts in my book, where I have some predictions for pricing for silver, kind of based on some of the trends that I'm seeing. And I get really kind of in details, why a lot of the industrial uses and some of the opportunity that's out there. But you can see right there in my book, I have a kind of similar price chart and prediction to what we just discussed.
And this is one of the best charts ever, if I'm not mistaken. That's the 50-year, 40-year cup and handle. So in the world of technical analysis, cup and handle is one of the most bullish formations you can have. If you want to use your imagination, what you see is that U-shaped cup and then that smaller handle formation. When you break out above that, usually it's a massive, sustained, multi-year breakout. And they say the longer in place, the higher in space. So there really is no other commodity that actually has such a large cup and handle formation as silver. And maybe this is a subject for another podcast, but if you look at some of the longer term targets and actually multiples that were done post 08, if we see anything like that in the next 5 years, Colin, you could be looking at $250 to $300 silver by 2030. Okay. Yeah. And that sounds crazy, but silver did 8.5 times in 3 years after 08.
Right.
Okay. It's not unheard of. So when a capital rotation event is upon us, the amount of capital, the amount of money that's going to be rushing in to the metals will be absurd. Right. Yeah. And people who own them now are the primary beneficiaries. If you're chasing at that time, it's a little more stressful.
Yeah. You don't want to chase that market. I remember it in 2011 because a few things happened that just the metal cost really goes up even beyond the spot price. Like right now is such an unbelievable time to buy. Premiums are lower than they've ever been. So it's just, blood in the streets, right? It's a good time to jump in. And I think that this is an extraordinary time. We're picking up metals at the best pricing in years. And it's because people are a little afraid, they're a little afraid because it's been a little sideways, in terms of trends. And but those trends don't last for a long time. And
No.
in the items that we, bullion bars and coins, the stuff that has the lowest premium, I would expect as we go through these bull runs, these multi-year bull runs, not only the price of silvers go up, but the price of the product will go up even higher. And what a lot of people don't realize, I mean, there was times during COVID where we were selling bars $3, $4, $5 above the spot price just because the demand was so high. So not only is silver going up, but you're getting a premium because you can't get it, right?
It's a great point. It's a great point.
And so it's a double win. And that's why when people talk to me about ETFs and all these things, is like, you're only going to win with the price, but you never win in that scenario. And when there's a shortage, and there will be shortages again, you win on price and you win on demand.
Absolutely.
And that's when really exciting things happen. And, I've seen, Silver Eagles were selling at $8, $9 above the spot price. And, clients would sell those back to us at, and they, not only they made the premium in silver, but they made that huge jump because of the demand.
Yeah.
And obviously we're buying it back because we need to sell it to new clients. So we're paying a premium. And the whole market was just a win-win. So when you go on these bull runs, there's multiple layers as to why you want to be in the physical product as opposed to the ETF.
Absolutely. Yeah, and that's a great point, Colin. I just want to add my experience, obviously, as a sales guy. And when you're dealing with clients to help them build their portfolios, there were times like, whether it was, spring of 2022, Russian-Ukraine invasion, spring of 2023, the banking crisis where those 3 banks blew up. In a very short period of time, with enough demand, we run out of supply, or at least out of the good stuff, right? Because the good stuff goes first. The more cost effective, the more desired it is.
Right.
But there are also times when the spot price is dropping, but the fabrication costs that we pick them up at are actually going up. And it's because spot price is coming down, demand is increasing, and so there's shortage of supply, and so the fabrication cost is actually rising. So you think that, price of silver is down, the silver is going to cost me less. Not necessarily. So at a time like this where price is relatively low and the cost of bullion above spot, those premiums are paper thin. Never been this thin. Across the board.
And then that's for me being in the business 16 years. Like I've seen it, and talking to a lot of the guys that are in the business that I've, talked to a lot, they've never seen the opportunity like today.
It's wild. I mean, I've been working for years now, Colin, and I have never sold pure 1 ounce silver rounds like this Trump round, but obviously not the Trump version, but a 1 ounce silver round cheaper than a 100 ounce silver bar.
Mm-hmm.
It's unheard of, right? To have something that's a 100th of the size costs less on a per ounce basis than a 100 ounce bar. Absolute bargain. And it won't last that long.
Yeah, no, absolutely.
Because we're, again, months, weeks, quarters away from something happening where we have this buying blitz, and it only takes a couple months of that pressure for us to see things kind of go.
Yeah, and I think this is a great time. And when you see it, at us, you see like this is always when the large investors buy because they've been through this so many times.
Oh, absolutely.
So you get these 7-figure, 8-figure transactions, and they always happen during this sort of, when things kind of level off because they see the opportunity.
Absolutely.
And my hope is always that it's not just those investors, that it's all the investors, the smaller investors too, that realize that the opportunity is there. And unfortunately, so many people just buy on the way up. But ultimately, I think this is just an unbelievable opportunity.
I agree.
I think we obviously want to talk for a minute just about the book, Silver is the New Oil, which, contact us if you're interested in learning about it. It's on Amazon. It actually hit number 1 on commodities today on Amazon.
Wow.
And so, took a few years to get this out, but I really dive into this silver opportunity. A lot of the chart you saw was from my book. And, I go on a lot of the uses that are there, but I really do think that the opportunity in silver reminds me a lot when you study oil in the late 1800s and you look at that massive opportunity that all those people found when they, started pulling oil out of the ground. I think that is coming again. I don't think silver is going to replace oil in every usage because oil's in everything, but I think that we are going to diversify and the world is diversifying. Saudi Arabia is diversifying. Everyone's diversifying into other energy sources. And silver will play a big part in that. And I think when you read the book, you'll see like, wow, I had no idea how much silver is kind of in everything in my life. Yeah. So for anyone,
and just such a cheap commodity, Colin. Like, what else can you think of is trading at roughly 50% of its 1980 price?
right.
Nothing.
Correct.
Literally nothing.
Yeah.
Nothing. So it's a steal. And I'm really looking forward to reading your book, Colin. So congratulations, actually. On
I'll get
the book.
you a
That is
signed
super
copy.
important.
I'll get you a signed copy.
Sounds great. So actually, Colin, if you don't mind, I want to just wrap these next couple sections with it, which I think are instructive as well. So I did talk about long-term, medium and long-term, tons of upside in silver. Shorter term, a buying opportunity with that negative divergence. But if we look at the gold to silver ratio, this is the price of silver divided into the price of gold. We're sitting very high right now relative to the average at about 91 ounces of silver, equaling the price of 1 ounce of gold. And we're at this interesting, that's crazy. The average is 15 to 1. We were at a 30 to 1 in 2011 after the global financial crisis. My own personal targets is that we get at least to the 30 to 1, which means you could triple your returns by owning silver now over gold if we go from a 90 to 1 to simply where we were at the end of the global financial crisis, which I think is a matter of when, not if. Now, it's just an indicator of how ridiculously cheap silver has become. But we're at a very interesting inflection point where we could actually break out to higher highs from here, which would mean either gold goes up a lot more or the price of silver drops, or let's say the price of silver and gold both drop, but silver drops more. That would cause the gold to silver ratio to move up. Now, in 2020, again, back to that volatility chart, back to that crazy time, something we could see again soon, we were at 120 to 1 ratio. That's the all-time high, only ever seen then. What we know is, actually, we don't know for sure, but this next chart, pardon me, is a really interesting chart that shows us that the gold to silver ratio actually breaking out is somewhat of a recession indicator. So anytime it's broken out above a descending trend line, it goes up and puts in a major move, which is normally right around a stock market crash or some type of capital rotation event. And so we saw them in 2000, we saw it in 2008, we saw it briefly in 2020. And the trend line that we have now kind of capping the current gold to silver ratio, if we break out above that, again, that could coincide with some kind of flash crash in tech stocks, something that corrects the S&P and the NASDAQ significantly. And again, at the early phases, early days, that initial reaction is for gold and silver to pull back. Now, if silver drops more than gold, that's what causes the gold to silver ratio to spike. But look what happens after every single time we get that type of breakout in the gold to silver ratio. You have a violent snap down in the gold to silver ratio, which actually means at that point forward, the price of silver is grossly outperforming the price appreciation of gold.
Yeah.
And so my 90 to 1 to 30 to 1 example is a 3 times outperformance. That means you triple your net returns. Or what I like to suggest to clients is they consider doing what I call the conversion strategy. You buy your 90 ounces of silver for the same price as 1 ounce of gold, hang on to that for the next 3 to 5, and at a 30 to 1, you're selling your silver back to buy 3 ounces of gold. The same amount of cash, triple the gold by riding silver in the meantime.
Right.
Unique opportunity to, again, own more gold or make more money. But this is something I'm watching intently. If we do get a breakout, which again could coincide with some type of capital rotation event, we could see much cheaper silver in the short term, but then it would snap violently back downwards and would mean an outperformance in silver. So it's a big opportunity.
Absolutely. Well, thank you, Micah. Appreciate it. Obviously a lot to digest today with everybody, but
thank you.
Hopefully, and if you have questions, contact us, contact Micah, call Noble Gold. We can get more into it on the specifics and also get into, what we offer clients with the IRAs, old 401ks. I mean, IRAs, people always ask why an IRA? And I said, for a lot of people, that's a lot where their net worth is. It's their house and their IRA. So it's a good place. It's also tax deferred. We are unique in that we offer all the service for the life of the account. It is real metals. It's all tax compliant. We help you all through that stuff. So anything that you have questions on, give us a call at Noble Gold Investments. And Micah, thank you so much. Brilliant today.
Thanks, Colin.
So much to learn. I appreciate it. And we'll see you on the next one.
Thank you so much.